Welcome to The Explainer. Today, we're going to dive into a really popular strategy that investors use to generate regular income from stocks they already own. It's called selling covered calls. We're going to get right into the nuts and bolts, the math, the mechanics, and really the mindset behind turning your stock portfolio into something that can pay you month after month.
So, this is the big question for so many of us who invest for the long haul, right? You work hard, you build up a portfolio of good companies, but then what? Beyond just hoping for dividends or for the price to creep up, how can you make those assets you own actually work for you on a regular basis?
And let's be honest, this challenge has gotten way tougher recently. When interest rates are hovering near zero, the old school way of earning passive income from a savings account, well, it just doesn't work anymore. As the Wall Street Journal put it, low rates might be great for people borrowing money, but for savers, they are, and I quote, far from happy.
Okay, so here's our game plan. First, we'll talk about this bigger search for income. Then, we'll get into the basic building blocks you need to understand, options. After that, we'll talk about this cool idea of renting out your stocks. We'll run the actual numbers on an example, look at the big trade-off between profit and capped gains, and then we'll tie it all together with a powerful philosophy about cash flow. So let's just set the stage here. In the current economy, investors are really on the hunt for new, reliable ways to generate cash flow. Just sitting around and waiting for dividends or for stock prices to go up can feel, well, pretty passive. This strategy we're talking about today is all about taking an active role and making your assets work harder for you.
All right, before we can build the house, we got to understand what bricks are made of. The word options can sound kind of intimidating, I know, but trust me, it's really just about learning a few key terms. Think of it like learning your times tables before you tackle bigger math problems. It's essential, and it's simpler than you think.
Okay, so what is an option at its core? It's just a contract. That's it. It's a contract that gives you the choice to do something, but not the obligation. It's like putting a down payment on a house to lock in the price for 30 days. You have the option to buy it at that price, but you don't have to. You just bought yourself a choice for a limited time.
A call option is just one specific kind of choice. It's the choice to buy a stock. So if you think a stock's price is about to go up, a call option lets you lock in the right to buy it at today's lower price, even if it's much higher a month from now. You're calling the stock to you. Now this is the important part for us today, the premium. This is the money that the buyer pays to get that choice we just talked about. For the buyer, it's the cost of the contract. But for the person on the other side, the seller, that premium is pure, upfront income. You get to collect that cash and keep it, no matter what.
And the strike price, that's just the agreed upon price in the contract. It's the price that is set in stone. If the buyer decides to use their option, the transaction will happen at that exact price. It's the magic number for the whole deal.
This slide really boils the whole thing down perfectly. It's a tale of two roles. You've got the buyer, who pays cash to get flexibility, to get a choice. And then you have the seller, who receives that cash in exchange for making a firm promise. And for our strategy today, we're going to be the seller. We're the ones getting paid to make the promise.
Okay, we've got the building blocks down. Now, let's put them together and build this thing. We're talking about one of the most popular income strategies out there for people who own stocks, the covered call.
Honestly, this is the best way to think about it. Imagine you own a rental property. You still own the house, right? But you let someone else use it for a while, and they pay you rent. This is the exact same idea. You own the asset, your 100 shares of stock, and by selling a call option, you're essentially renting out the potential upside to someone else. And that premium you collect, that's your monthly rent check.
Now that word covered is absolutely critical. It's what makes this a relatively conservative strategy. It means you already own the stock you're promising to sell. See, one options contract represents 100 shares of stock. So you own at least 100 shares and you sell one contract. Those shares you own are your collateral. They cover your promise, so you're never on the hook for something you don't have.
All right, enough with the theory. Theory's great, but let's see how this actually works with real money. We're going to walk through a trade step by step to make this crystal clear.
So check this out. Let's say you own 100 shares of some stock, we'll call it XYZ, and you paid $51.72 a share. That's your initial cost. Now, you decide to sell one call option that expires in 30 days. And look at the strike price. It's $52.50, a little bit higher than the current price. For selling this contract, you immediately get paid a premium of $1 per share. Since one contract has 100 shares, that's $100 that goes straight into your account. And look what that does. It instantly lowers your break-even price on the stock down to $50.72.
Okay, so you fast forward 30 days to expiration day. One of three things is going to happen. Scenario 1, the stock price is anywhere below $52.50. The option is worthless to the buyer, so it just expires. You keep the $100 premium, and you keep your 100 shares. Awesome. Now you can do it all over again next month. Scenario 2, the stock is above $52.50. The buyer will use their option. So you sell your shares for $52.50 each, and you also keep that original $100 premium. That's a win-win. And scenario 3, what if the stock price drops? Well, the option still expires worthless, you still keep the $100. That premium acts like a small cushion. It helps offset a little bit of the loss on your shares.
Now let's look at the return if your shares get sold. That's scenario 2. You made a small profit on the stock itself, right? $78. Plus, you have that $100 premium you collected up front. So your total profit is $178 on your initial investment. You do the math, and that works out to a 3.4% return in a single month. That's pretty powerful.
Okay, a 3.4% monthly return. That sounds amazing, maybe even a little too good to be true. And that means we have to talk about the trade-off. Because in investing, there's no such thing as a free lunch. It's so important to understand what you're giving up to get that steady income.
And here it is. This is the core bargain you are making. The reward is that consistent, predictable income. That premium shows up in your account every month like clockwork. The risk, or maybe a better word is the opportunity cost, is that you've capped your potential profit. If stock XYZ has some incredible news and shoots up to $70 a share, you don't get to ride that wave. You still have to sell your shares at the agreed-upon price of $52.50. You're trading away the home run for a very consistent single or double.
This quote just nails it. The whole reason you do this is to get that premium, which reduces your cost and lowers your risk. But the price you pay for that benefit is giving up that massive, unlimited upside potential. Again, it's about trading those potential home runs for a consistently high batting average.
So let's just zoom out for a second. This covered call thing, it's not just a clever trading tactic. It's actually a window into a totally different way of thinking about investing, a philosophy that a lot of really successful people use.
This is the huge mindset shift. Most of us are taught to focus on our income from a job. But this philosophy says, no, focus on buying assets, things like stocks, real estate, businesses, and then figure out how to make those assets produce their own income streams. A covered call is the perfect example. You're taking an asset, a stock, and you're making it work for you, making it pay you every single month.
So I'll leave you with this final thought to chew on. What if you stopped looking at your stock portfolio like it was just a savings account and started seeing it as a portfolio of little rental properties? What if every stock you owned had the potential to pay you rent each month? How would that change the way you invest? How would that change your financial picture? That's the powerful idea we're talking about today.